Welcome back, ladies and gentlemen. You're listening to another edition of DIY Money.
DIY Money.
So we've cut a series of podcasts this morning, both the series we're doing right now and a few other podcasts. I've had no caffeine today.
Yeah, you're being a champ.
It's not
right
by
now.
choice. So for those of you that are laughing at my caffeine exploits, I will tell you that I was off caffeine for a good several months. It was amazing. I swore it off forever. Then I did a long run, and I ingested like a ton of caffeine on the long run, and I ran great, by the way. And so at the end of that, I was like, well, I'll just get a coffee because I've already hopped up on caffeine.
Game over.
And I got a coffee, and I was like, oh, I missed you, coffee. This is so nice. And so the next morning, I was like, well, I got up. It's a Sunday. I'm like, well, it's a Sunday. I'll just have a cup of coffee. And the next thing you know, I'm having coffee every day. I'm buying coffee at the store. I'm back to Starbucks, getting the points, blah, blah, blah. So I'm back on the coffee, which is devastating. But today I have a doctor's appointment, and I didn't know this. I would never have booked the doctor's appointment for 1:30. Ever. Would have done that. I get blood drawn. I'm like, what's the earliest you can do?
Right.
Because I'm going to Starbucks immediately thereafter. And yesterday afternoon, I get one of those reminder calls. I just go to voicemail, right? Because I've already checked in online and done all the things. By the way, why do they have you check in online and then you show up and they give you 75 pages to fill out? What the crap is that?
Like, did
makes
you
no
not
sense
get
at all.
what
I just filled this out. But anyways, I get this voicemail, and I listen to it, and it says, yeah, please don't have any caffeine after midnight. And I'm like,
Oh,
what?
no.
It's a
Did you know I'm cutting 6 episodes?
Oh, so anyways, no caffeine today. I'm starting to get that headache. I got a little ibuprofen in the pocket, so I'll take that later. But anyways, yeah, we're on the last one. But this is fun. So this is kind of the culmination of what we've been talking about in this series. And this series is good. I mean, it's going to kind of last the test of time. Allie did a great job breaking down the taxes. If you missed that, you can go back to that. It is important to understand tax ramifications, and you can do some further deep dives in that on your own. The second one is basically, the buckets and the various methodologies behind what is investing, what are you investing in through mutual funds, ETFs, index, passive, etc., as well as, asset allocation, diversification, rebalancing. Fantastic episode. Now we're going to talk about, and listen, 80% of you can tune this out, and you don't need to listen to this, but every once in a while, we get a person that says, you know what, I'm interested in buying stocks. I'm interested in buying companies. Now, there are people out there that do shows like ours, and they immediately are like, don't do that. Why would you do that? Don't be an idiot. Blah, blah, blah. That's ridiculous. Listen, I don't agree with that. I kind of fall on the Jim Cramer side of things, even though sometimes he's a little bit crazy, but he's done amazing things for education and finance. But when people have an interest in buying companies and shares in stock of companies, and they want to learn about it and do the homework and sometimes suffer the consequences of being bad at it, because it sometimes takes years for you to gain some success in this, I'm all for it. So where do you want to start?
Yeah, so first of all, let's just pause real quick. We do have questions that we do. That's how we run the show normally. So send those questions in, podcast@DIYmoney.org. That's podcast@DIYmoney.org. We're also going to do just a quick break real quick to talk about our sponsors. First of all, our number one sponsor, Jewel Financial. That's what we do on our day jobs. We talk about stocks all the time, so this is kind of fun for us. All right, so Quint, I think it would be really fun if we're doing this, talking about individual stocks, to kind of go almost like age demographic up in the way. So like if we're starting out, someone that's brand new to this, maybe it's a child, or maybe it's someone that's just now starting out, there's their first investments, their first opening of an account, and they're just starting out to look at stocks, look at companies, and evaluate putting those in their portfolios. How do they start that?
Yeah. Well, first of all, parents, let me speak to the parents who are going to empower your child to do this, which I think is phenomenal. Bravo to you. Understand, though, you and them are entering in a world that is incredibly vast, has its own lingo, and will not be learned overnight. It's probably one of the biggest challenges I have, and I'm sure I was this way, is when I come across an enthusiastic young investor, they want to try and learn everything right now. And the reason that's ultimately impossible is because you have market cycles, and those cycles are dependent upon things that are happening that may have never happened before. So it's very unique. It's a very unique business. It's not like becoming a meteorologist, and I mean, no downplaying the meteorologist, but you got rain and snow and wind and tornadoes and like maybe 10 different weather patterns in the markets. It's infinity.
Yes.
It's it's infinity.
Yeah,
like,
and you can't just learn it from, I mean, I went to school for 4 years in finance, and then I studied for a CFP. That certainly did not give me the full education of scope that I've learned through these market cycles we've been going through the last couple of years.
And it's a never-ending learning. And that's, okay, so if you have a curious mind at home, this may be wonderful for them. So 25 years in the business, and my first stock was at 12, which is, what is that? Golly, that's 36 years ago? Holy cow. So my first stock I bought 36 years ago, and I'm still learning every day. If you have a young person, the angle I would always go with them is to buy what you know, what you are interested in. And by doing that, they will become aware of stock movement. They will be aware of news that can impact the stock. They will start to understand things like quarterly earnings, maybe read the CEO letter, whatever it might be that is going on with that company, they're following. What's most important as well is if it's a company that you buy the products or utilize the service of, is to know that that child or you or whomever it is an actual owner of the company. I think the critical piece that's missing in so many investors is the idea that they're actually owning a business. And when you actually believe you're owning a business, then this transactional kind of attitude of buying now and selling later goes out the window. Now, there are times for that. Make no mistake. There are times where a transactional type of business, this is a theme that's happening right now, and I think this stock's going to do well because of this theme, and I'm going to buy it, and in 6 months, the theme might be out of favor, and I'm going to sell it. That's a transactional, short-term sort of thing. Most people don't even need to venture into that, but there is a place for it, and I know people that do it all the time. But if you can get your young person, or you, if you're just starting out, kind of indoctrinated to the idea that you're part owner of a company, that right there will help you a great deal going forward.
Absolutely. Buy things you know is basically how I learned this business as well in your class. So in your class, we picked a stock because we had a person in our group that was a runner. They loved Hoka shoes, and that's how we learned about Decker's Outdoor, and that's how we learned about that company and looked at their balance sheet and evaluated if it was a good stock or not. So starting with learning what you know and buying companies that you interact with on a daily basis is definitely a great way to start out. Okay, so let's move past that. You've started out. Maybe you started to buy things you know, but now you have some money and you're building an actual portfolio that might have some index type mutual funds, ETFs, but now wants to have some individual companies that add on around that. What is the starting point for someone? Like, do they start with where they're going? Do they start with just looking at companies in the S&P 500? Where do they go from there?
Yeah, this is great. So the first thing I want to say about this is, I mean, and we could spend hours doing this, but there's no shortcut. All right, that's number one. There's no shortcut. There's no, perfect solution either. I feel like very intelligent people, they end up sometimes becoming the worst investors. And the reason is they want it to be black and white. They want 2 + 2 to always equal 4 in the investment world. And it doesn't always happen that way. And so those two things you have to understand. Again, no shortcuts, and there's no clear-cut methodology or solution. So stop looking for the genie in the bottle. Stop looking for it because it's not there. So it's a process. I would say the element of buy what you know can always play a part, but you have to start to develop some sort of system. And there's a million systems. Now, what do I mean by a system? There are certain things called fundamental investing. Fundamental investing is analyzing the financials of a company and trying to ascertain when it's on sale. Okay? That's fundamental investing, and that's often called fundamental value investing. So you're looking for value, as opposed to fundamental growth investing, where you're looking for companies that are growing exponentially, and therefore their stock will grow as well. So there's fundamental investing. There's also something that's called technical investing, and that's often sort of, looked at like kind of voodoo, and it's a very strange, weird thing. And I ironically have a past where I have a unique flavor of both. I came from a family and a background in fundamental investing, and then I went to a hedge fund learning from a trader who used both fundamentals and technicals for trading. So I learned kind of both, and we use both today for a variety of reasons. But I would say most people who are looking at buying individual stocks, holding them for a long time, investing in the company, etc., should adopt some sort of methodology by which they understand the business and the financials of that business, so they feel comfortable buying the stock at a certain price. Now, that's here what we open the show with. You're entering a new world. The terminology is vast. We're not in 15 or 20 or 30 minutes going to open some Pandora's box for you that sends you down the path of learning from other investors who have probably written on this topic ad nauseum. And the greatest place to go for this and to follow, in my opinion, one of the best investors in the world is Warren Buffett. And what's cool about Warren Buffett is at any moment in time, you can see exactly what he owns. In fact, you can go and see what any individual investor owns. The government, the SEC, mandates that they file on a quarterly basis what they own. There's a cool website, I think it's called Datarama, DATAROMA.com. We'll put it in the show notes. You can go there and you can see the latest filing in the summary of companies or investors like Warren Buffett and Bill Ackman and so on and so forth. So you can start to read what they're doing, read their methodologies,
what they're adding, what they're cutting, what they're doing,
why they're adding. But at the end of the day, you're going to have to adopt some sort of methodology that gives you a comfort level of buying a company today and holding it for the next 5-10 years, even when you're wrong for a season. Because that's what happens with value. Value investors are often wrong for years. Warren Buffett owns a stock right now, Occidental Petroleum, and he owns a lot of it. I've watched Occidental Petroleum. We've owned Occidental Petroleum. I'm sure it's a great thesis, but so far, he's been wrong. He's been wrong on that stock. It's down. It continues to go down. It's so frustrating. But he feels obviously very confident. This is not a recommendation, and we no longer own it, by the way. We clearly didn't have the patience that he did. Not a recommendation by the stock, but he clearly has the comfort level that he's going to continue to buy this stock no matter what, no matter whether the stock goes down or not. And he says this about all of his investments. He didn't care if the market closes for a year. But you have to adopt some sort of methodology. And by the way, that methodology is not, I heard about it on TV, or I read about it in an article, or some guy was on some show on Sunday and talked about this stock and I want to buy it. That is nonsense. I often say that's gambling. Go to Vegas. They'll give you free drinks.
Yeah, absolutely. And when you do this, when you develop your methodology, you could go back to a couple episodes ago where you and I talked about also having ways that you might peel back the stock, might have some selling points for those different companies that you have. Or you might have a level where if the price goes below that level, you're selling it. Or you might have the methodology of, I'm going to evaluate these companies, I'm going to look deep at their financials, I'm going to look at their future cash flows, I'm going to buy it when I feel like it's a value, and I'm going to hold it until that thesis changes. And there's a lot of people that do that. I mean, that's kind of the Buffettology type method for owning companies. I want to kind of bring it back, though, because it's really important to still maintain those fundamentals that we talked about in the last episode and that we kind of started the episode talking about is you need to still have diversification. You need to still understand your allocation, because even if you're adding these individual companies to a portfolio, I have people that come in and they say, yeah, I really like JP Morgan, but it's a 20% position in your portfolio, you're not following the basic principles. Even though you've done the research, even though you've looked at these companies, you have to remember you can always be wrong. So you got to follow those basic principles of having diversification, keeping your percentage allocation to these individual companies in a range that you're comfortable with, and knowing that any of these companies you buy, even the blue chip companies, can go down significantly.
Most investors cannot beat the S&P 500 over a long period of time. And when I say long, I mean 5 to 10 years. They cannot beat it. So if you have interest in this, the recommendation I always make to somebody is take a very, very small piece of your overall portfolio, do what you want to do, and have a realistic discussion with yourself after several years. Is this worth it? Are you costing your money, costing yourself money? Are you making more money? And if you're not, let's say the S&P is beating you marginally, but you love it, and you've only been doing it for, and you're like, this is the greatest thing, this is the greatest hobby I've ever. Well, then keep doing it. Like, why not? But if you're terrible and you're trying to time the market and you're getting your stock picks and blah blah blah, and the S&P is just chugging right along and doing its thing, and you're like, this is ridiculous, then you have to be honest with yourself, and you have to know that you can't do it. I know you didn't ask about this, and I know this has nothing to do with stocks, but a lot of times in our business, people sometimes say, well, why would I pay you 1%? And I say, well, because I'm going to keep you from doing dumb things. And they kind of take offense to that, but they really know what I mean. And what I mean is, I'm not going to panic sell at the bottom. More than likely, I'm going to buy something for you at the bottom. When it gets euphoric and you're thinking that, oh, this is the greatest thing since sliced bread, and we're all high-fiving, I'm probably going to be rebalancing or trimming. Like, I'm going to be the unemotional buffer that keeps you in the game for the long haul. And the number of times that has come to fruition. Do we beat the S&P every year? No, absolutely not. But over a long period of time, are we performing in line with someone's goals and expectations for their overall plan? The answer is yes, because we stay disciplined, we adhere to our process, our proven process, and we don't mess around. And many people, again, it's like they get excited about this, they like the idea of it, or heaven forbid they pick a stock that actually goes up a lot, and then they think they're a genius, and then they get crushed. It's just, I've seen it a million times. But be smart about it and know that this is a very, very difficult game.
And I think the last point I'm going to end on is you have to know that you can be wrong, because it's going to happen a lot. I mean, we don't get it right all the time, not at all. So, I mean, we buy a company like Intel, and it continues to go down over time and not perform well. Well, we are willing to cut that. You can't treat these companies or these stocks like your children, like you're just going to add them to your portfolio and they're going to be there forever, and you nurture them no matter what happens with them. You have to understand and look into, did something with my thesis for buying this company change? And maybe it changed because the company just continues to go down, and I need to now cut it from my portfolio. You have to be willing to admit, hey, this is not a great investment. I'll go somewhere else.
We've talked about Warren Buffett. I'll leave you with a last resource, which I think is the best, and he's relatively unknown, which is surprising to me, but a gentleman by the name of Bill O'Neill. He's since passed away. Bill O'Neill was kind of one of the godfathers of investing, more in line with growth companies. He called them growth at reasonable price. And he wrote a book, How to Make Money in Stocks, and it really gives a novice investor a true game plan of how to invest, what to look for, and how to protect themselves. And I think it's very, very good. I'm an advocate of it. I'm a fan. I actually, before he died, I sent him my copy for him to sign. So I have a signed copy of his book, which I just think is fantastic. But again, I am a big Bill O'Neill fan, and we subscribe to a lot of their methodology today, along with a variety of other methodologies that we've kind of used to make our own. But I encourage, go back to where we started in the beginning. I am not one to just poo-poo and say, oh, you shouldn't do that. People reach out to us all the time. What do you think about this stock? I'm like, I wouldn't buy it, but if you want to buy it, we'll send you some money out of your account. We'll open another one account for you, and you manage it. And sometimes they're like, no, I don't want to do that. But, that's okay, too. Anyways, all right, we'll end right there. Remember, friends, the secret to wealth is pretty simple. Live on less than you make, invest the rest, and do so for a very long time. Make it a great one.